Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at unusual machines.
If you find our talks useful, please consider subscribe, like, and comment underneath. And, before we really get going, just a quick reminder to check out this special 14-day trial link below in the description for StockOracle.
Right. Yeah, StockOracle is this AI-aided stock research platform. Obviously, it's not financial advice, and it's definitely not a trading signal service or, real-time market data, but it's super helpful for pulling up these metrics.
Exactly. And just full transparency, that is an affiliate link in the description, so the channel may earn a commission at no extra cost to you. And do keep in mind that StockOracle's AI insights and valuation estimates, well, they can be incomplete or wrong. Always verify the important facts yourself.
Yeah, you always have to do your own homework.
Absolutely. So let's get into unusual machines, or ticker UMAC. Today we are unpacking a classic investment paradox. I mean, what happens when a company has this explosive, just off-the-charts growth and massive geopolitical tailwinds, but it's flashing these bright red warning signs under the hood?
It's such a fascinating setup. On one hand, you have a stock that's up over 154% in a year, right? With a 600% revenue jump.
Which is wild.
It really is. But on the other hand, you have these extreme valuations, and the insiders are quietly heading for the exits.
Okay, so let's unpack this. Because for anyone trying to build wealth in this market, UMAC is the perfect case study. It shows exactly why you can't just read a headline about massive revenue growth and hit the buy button. You have to look at the whole picture.
Exactly. We really want to deconstruct this paradox for you. When you look at their filings and the market coverage, it's a masterclass in how surface-level metrics can just wildly deceive you.
Yeah, they flash these incredible buy signals on the balance sheet, but then you look at the cash flow statement and it's waving massive red flags.
Right. But to understand the red flags, you kind of have to understand the hype first. The market is aggressively bidding up unusual machines right now.
Oh, for sure. And when you look at the headline numbers, it's really not hard to see why. I mean, for the first half of 2026, UMAC reported revenues of $24.8 million.
Which is huge.
Yeah, because in the first half of 2025, that number was just $4.1 million. That's a roughly 6x year-over-year growth rate.
And that momentum is, well, it's even more pronounced when you isolate just the second quarter. Q2 alone delivered $16.7 million in revenue.
Wow.
Yeah, that represents a 687% jump year-over-year. To put that into perspective, Wall Street analysts had estimated they'd do about $9.2 million for the quarter.
Wait, so it didn't just beat the estimate, they nearly doubled it.
Exactly. They shattered the consensus. And when a company does that so comprehensively, institutional money just has to completely recalibrate its growth models.
Right. And you can see that recalibration on the balance sheet. By the end of June 2026, Unusual Machines reported nearly $230 million in cash and cash equivalents.
That's a massive war chest.
It really is. And against that $230 million, their total liabilities sit at a mere $9.4 million.
Leaving them with over $388 million in stockholders' equity.
For a company this size, I mean, that is fortress-level liquidity. Minimal debt, huge cash reserves. But, and this is where I kind of get hung up, it creates this mathematical weirdness.
Yeah, it really does.
Like if you run a lemonade stand that makes $24, but you somehow have $229 in the cash register, you have to ask, where did the rest of the money come from?
That is the exact right question to ask. A company generating $24.8 million in half-year top-line revenue just doesn't organically amass a $230 million cash pile.
Right, because selling drone parts costs money.
Exactly. The core business simply isn't generating enough capital to build a treasury of that magnitude, especially not with the operating costs of scaling hardware manufacturing.
Which means we have to stop looking at the income statement and shift over to the cash flow statement.
Right, because that's where you see the actual cost of this hypergrowth. For the first half of 2026, UMAC's operating cash flow was deeply negative. They burned through $38.9 million just to run the business.
Ouch, that's a lot of cash burn.
And the trajectory of that burn is the critical detail here. Back in the first half of 2025, their operating burn was only $3.8 million. So while their revenue multiplied by 6, their cash burn basically multiplied by 10.
Oh, wow. So the faster they scale, the wider the gap gets between the cash they collect and the cash they spend.
Exactly. They're spending a fortune building out their supply chain, funding R&D, and managing inventory.
Okay, so if they're burning almost $39 million from operations, that $230 million cash fortress definitely didn't come from selling drone components.
No, it didn't. Given the lack of new debt on the balance sheet, that liquidity almost certainly came from the capital markets, meaning equity raises.
Ah, so they're printing and selling new shares of stock to fund their day-to-day operations.
Exactly. And for anyone holding the stock, that introduces severe dilution risk. When a company consistently issues new shares just to keep the lights on, the percentage of the company you actually own shrinks.
Your equity just gets watered down.
Right. Having $250 million in the bank provides phenomenal runway. But if that runway is paved entirely by diluting existing shareholders, the underlying business model hasn't actually proven it can sustain itself.
And we really see that lack of sustainability in their profit margins.
Mm-hmm.
I mean, the net income volatility here is just extreme. In Q1, UMAC posted a $10.2 million profit.
Right.
But then in Q2, despite that massive $16.7 million revenue beat we talked about, they posted a $7.7 million loss.
Yeah, it's a huge swing.
Their trailing 12-month net margin sits at negative 32.7%. So for every dollar of revenue they generate, they're losing roughly 33 cents. And their Q2 earnings per share came in at negative 16 cents.
That kind of wild swing from a $10 million profit to an almost $8 million loss in a single quarter, it suggests highly lumpy revenue recognition.
What do you mean by lumpy?
Well, in the defense and aerospace component sector, contracts are rarely smooth, recurring subscriptions,
Right, it's not like a software company.
Exactly. You deliver a massive batch of hardware, you recognize the revenue, and you show a profit. But then you spend the next quarter buying raw materials and scaling production for the next contract, and you show a massive loss. The business just hasn't reached a steady state of operational profitability yet.
Okay, so let me get this straight. You have a company burning almost $40 million in cash over 6 months, operating with a negative 32% margin, and heavily diluting its shareholders to pad its balance sheet.
That's the reality, yeah.
Yet, Wall Street heavyweights remain incredibly bullish. Piper Sandler recently initiated coverage with an overweight rating and a $38 price target.
And NIDA maintained their buy rating and actually bumped their target from 30 up to 40.
Which is crazy to me. Analysts don't set $40 price targets on a $27 stock burning this much cash unless they see some structural catalyst that just completely dwarfs the operational inefficiencies.
And they do see one. The catalyst they're looking at is entirely macroeconomic. They're modeling a future where Unusual Machines benefits from this massive government-mandated structural advantage.
The tariffs.
Yes. The White House recently announced a comprehensive slate of tariffs specifically targeting imported drones and foreign drone components.
Right. And just to be clear, for you listening, we're looking at this purely as an economic variable. We're not taking any political sides here. We're just reporting on how this policy impacts the supply chain.
Exactly. It's just market mechanics. The U.S. government is implementing a 15% tariff on drones and components originating from key global trading partners. So that's the European Union, Japan, South Korea, Taiwan.
There's also a separate 10% tariff applied to UK origin drones, right?
Yeah. And crucially, there is a staggering 100% tariff placed on certain sensitive categories of drone technology.
100% tariff, that's huge.
It's essentially a ban by pricing. When a 100% tariff hits a sensitive hardware category like flight controllers, optical targeting sensors, or secure communication arrays, the foreign supply chain is basically priced out of the U.S. market overnight.
So a component that used to cost a U.S. defense contractor $500 now costs $1,000 if they import it.
Exactly. The government is actively building a competitive moat around domestic manufacturers by decree.
It mechanically forces U.S. aerospace companies to just tear up their existing foreign supplier contracts and resource those components domestically.
Right. And if you are Unusual Machines building drone components inside the United States, your products just became infinitely more attractive on a relative price basis.
And we're already seeing institutional capital front-running this supply chain shift, aren't we? Jane Street recently acquired a 2.8% passive stake in UMAC.
Yeah, and Jane Street is a highly sophisticated trading firm. They're clearly positioning themselves for a domestic manufacturing windfall.
So the logic behind those Piper Sandler and Needham price targets hinges on this exact dynamic.
It does. However, there's a catch. A tariff creates an industry-wide moat, not a company-specific one. The major blind spot in this bullish narrative is the lack of quantifiable market share data.
Meaning we don't actually know how much of the market UMAC controls?
Exactly. We know the domestic pie is being artificially protected, but we don't know how big UMAC's slice actually is. They could be the primary beneficiary, or they could just be outscaled by larger legacy defense contractors who decide to pivot into the component space.
Which brings us to the reality check. The intersection of these competing narratives and the actual stock price. We've got the 600% revenue surge and the geopolitical tailwinds pushing the stock up. But we have the severe cash burn and dilution pulling it down.
So let's look at the technicals. UMAC recently closed at $27.24, which puts it up nearly 155% over the last 52 weeks.
The momentum is definitely undeniable, but the technical indicators suggest the stock is stretching really far beyond its historical baseline, right?
Oh, absolutely. It's currently trading well above its short-term 20-day and 50-day moving averages. But the real disconnect is the 200-day moving average, which is lagging all the way down at $16.19.
Wow, so the stock has completely detached from its long-term trend.
It has. Plus, the relative strength index, the RSI, is sitting at 68.09. That places it dangerously close to the 70 threshold, which traditionally signals an asset is overbought and vulnerable to a pullback.
Okay, so the technicals tell you the stock is running hot, but the valuation multiples tell you what the market expects going forward. And UMAC's valuation is, well, frankly, it's terrifying for a hardware company.
It really is.
The trailing 12-month price-to-sales ratio is currently 78.28x. Investors are paying $78 in market cap for every single dollar of revenue the company brings in.
A 78x sales multiple is aggressive even for a purely digital software-as-a-service company with 85% gross margins. For a company manufacturing physical hardware, bending metal, soldering circuit boards, managing physical inventory, dealing with real-world supply chain logistics, it is practically unheard of.
Because hardware companies have terminal margins that are fundamentally constrained by, well, physics and logistics.
Exactly. At 78 times sales, the market has priced in absolute perfection. There is zero margin of safety here. You are not buying the company as it exists today. You're buying the company as it might exist 5 years from now, assuming they capture the entire domestic drone component market without a single misstep.
And a misstep might be happening right now. We have to look at the execution risk embedded in management's own forward guidance. Remember, Q2 delivered that massive $16.7 million revenue figure.
Right.
But management's revenue target for Q3 is only $12 to $14 million.
Which means they are projected a sequential decline. When a stock is trading at 78 times sales, the absolute last thing you want to see is shrinking quarter-over-quarter revenue.
A drop from $16.7 million to $12 million kind of implies that the Q2 beat might have just been pull forward demand rather than a sustainable new baseline.
Yeah, that's a very real concern. Now, management does promise a sharp recovery in Q4, targeting $25 million in revenue for that final quarter.
But if they deliver a soft Q3, the pressure on that Q4 number becomes existential for the stock price. If they miss that $25 million ramp up after forecasting a sequential decline, the narrative holding up that 78x multiple will just shatter.
And the people who understand that pressure better than anyone are the executives inside the company. Which brings us to the starkest reality check today, their recent trading activity.
This is the part that really stood out to me.
Yeah, according to the transaction data, corporate insiders have executed 8 separate open market sales, offloading a total of 327,429 shares.
Almost 330,000 shares sold by insiders. Meanwhile, the number of open market insider purchases over that same period is exactly 0. Not a single executive or board member has bought a share on the open market.
0 buys.
It's the classic corporate warning sign. It's like the captain of the ship is on the loudspeaker promising the passengers a smooth voyage to a $25 million Q4 while quietly loading their own luggage into the lifeboats.
That's a great way to put it. Now, executive compensation often includes restricted stock units, and insiders frequently sell shares to cover tax obligations or diversify their portfolios.
Sure, a few sales are standard corporate housekeeping.
Right. But dumping over 320,000 shares across 8 transactions with 0 corresponding buy-ins paints a very specific picture. Insiders only buy stock on the open market for one reason. They believe it's undervalued.
And the complete absence of buying pressure from the executive suite suggests they look at that 78x price-to-sales multiple and recognize the market has already rewarded them for growth they haven't even achieved yet.
Exactly. So synthesizing all these data points from the filings, the analyst reports, and the technical indicators, the most responsible stance to take on unusual machines, our investment rating, or bullish score, if you will, is neutral.
Yeah, neutral is really the only place to land. The bull case is undeniable, right? $230 million in cash, minimal liabilities, and a government tariff structure that effectively kneecaps their foreign competition.
If domestic drone production scales the way defense analysts expect, UMSC is positioned in the exact right sector at the exact right time.
But the bear case is equally undeniable. They're burning cash at a rate that necessitates constant shareholder dilution, their net margins are deeply negative, and their valuation is priced for an immaculate execution that their own Q3 guidance suggests they might not achieve.
Add in the heavy insider selling, and you have a stock where the downside risk completely offsets the macroeconomic tailwinds. The market is betting aggressively that Unusual Machines will evolve from a cash-burning, heavily diluted operation into the dominant cornerstone of the American drone supply chain.
And long-term, that transition is entirely possible. But at $27 a share, you are paying a massive premium for a transformation that is still highly theoretical.
Which brings up a really provocative underlying question that this whole situation raises. We've spent this time analyzing UMC through the lens of traditional financial metrics, cash flows, moving averages, price-to-sales ratios.
Right.
But we are talking about domestic drone production. This is an industry that is rapidly migrating from consumer electronics into the realm of critical national defense infrastructure.
It really forces you to ask whether the old rules of corporate valuation even apply anymore. I mean, if securing a domestic drone supply chain becomes a non-negotiable existential priority for the United States government, does a 78x multiple actually matter?
It's a fascinating paradigm shift to consider. Are we entering a new era of defense tech hardware where a company's geopolitical importance completely overrides its fundamental financial inefficiencies?
It is definitely something for you to mull over as the line between national security and private market economics continues to blur. If you found our talk useful today, please consider subscribe, like, and comment underneath.
And don't forget to check out that special 14-day trial link for StockOracle in the description below. Just a reminder, it is an AI-aided research platform to help you find these metrics, but it is not financial advice, and you should always verify the facts.
Yep. Do your own research, stay safe out there, and we'll see you in the next one.